The year is 2025. The world has changed in many ways, but some things remain eerily familiar. The global stage is once again set for a confrontation that could reshape economies and alter the course of history. The world watches with bated breath as the United States, under the leadership of a resurgent Donald Trump, announces a new wave of tariffs on goods imported from China. This move, reminiscent of his earlier tenure, signals a return to aggressive trade policies aimed at curbing China's economic influence. This decision sends shockwaves through the global economy, evoking memories of the trade wars that defined Trump's previous presidency. Traders on the stock exchange floor react with a mix of anxiety and anticipation, knowing that the stakes are incredibly high. The specter of protectionism looms large, threatening to unravel the delicate fabric of international trade. Container ships, once bustling with goods, now face delays and increased scrutiny at ports. Empty store shelves become a common sight as supply chains are disrupted. Memories of the 2018 to 2019 trade war, where tit-for-tat tariffs between the US and China roiled markets and disrupted supply chains, are still fresh in the minds of investors and businesses alike. The scars from that period have not yet healed, and the fear of a repeat performance is palpable. The question on everyone's mind is whether history will repeat itself, plunging the world into a new era of economic uncertainty. Investors watch stock tickers with bated breath, while business leaders huddle in meeting rooms strategizing on how to navigate the turbulent waters ahead. As news of the tariff spreads, financial markets react swiftly and dramatically. Stock market tickers show plummeting numbers, and traders are seen frantically making calls, trying to mitigate losses and capitalize on any potential gains. The value of the US dollar surges, reflecting its safe haven status in times of global turmoil. Investors flock to the dollar, seeking refuge from the storm, even as the broader market experiences significant volatility. Meanwhile, stock markets around the world tumble, as investors grapple with the potential fallout from a protracted trade war. The fear of a prolonged economic conflict sends ripples through global financial systems, causing widespread panic and uncertainty. This essay will delve into the complex relationship between Trump's tariffs, the surging dollar, and the diving stock market. We will explore the potential long-term impacts of these policies on both the US and global economies, examining how businesses, investors, and everyday citizens might be affected. The intricate dance of international trade, political maneuvering, and economic strategy will be laid bare, offering insights into the possible future that awaits us all. Tariffs, in their simplest form, are taxes levied on goods imported from other countries. These taxes can vary widely depending on the type of goods, the country of origin, and the specific trade policies in place. For centuries, tariffs have been a fundamental tool in the arsenal of economic policy, shaping the flow of international trade and influencing the economic landscape of nations. They act as a barrier to trade, making imported goods more expensive for consumers and businesses. This price increase can lead to a shift in consumer behavior, as people may opt for cheaper, domestically produced alternatives. The impact of tariffs is felt not just at the checkout counter, but throughout the entire supply chain, affecting manufacturers, retailers, and ultimately, the end consumers. Governments often impose tariffs to protect domestic industries from foreign competition, to generate revenue, or to achieve specific geopolitical objectives. By making imported goods more expensive, tariffs can give a competitive edge to local producers, helping them to grow and sustain their businesses. This protectionist measure can be particularly crucial for emerging industries that are not yet ready to compete on a global scale. Proponents of tariffs argue that they level the playing field for domestic producers, safeguarding jobs and promoting economic growth. They believe that by shielding local industries from the pressures of international competition, tariffs can help to preserve vital sectors of the economy, ensuring that jobs remain within the country and that local businesses can thrive. They contend that tariffs can help reduce trade deficits by making foreign goods less attractive to consumers. A trade deficit occurs when a country imports more than it exports, leading to an outflow of domestic currency to foreign markets. By imposing tariffs, governments can encourage consumers to buy locally produced goods, thereby reducing the trade deficit and keeping more money within the national economy. Additionally, tariffs can be used as a bargaining chip in international trade negotiations, pressuring other countries to offer concessions. In the complex world of global trade, tariffs can serve as a powerful tool for countries to negotiate better terms and agreements. leveraging their market power to achieve favorable outcomes in trade deals. However, critics of tariffs argue that they ultimately harm the economy by raising prices for consumers, reducing the purchasing power of their income. When the cost of imported goods rises, consumers have to spend more to purchase the same items, leaving them with less disposable income for other needs and wants. This can lead to a decrease in overall consumer spending, which is a key driver of economic growth. They also argue that tariffs distort markets, leading to inefficiencies and a misallocation of resources. By artificially inflating the prices of imported goods, tariffs can disrupt the natural balance of supply and demand, causing resources to be diverted away from their most productive uses. This can result in higher costs for businesses and consumers alike, ultimately slowing down economic progress. Furthermore, tariffs can invite retaliation from trading partners, triggering a downward spiral of protectionism that harms all parties involved. When one country imposes tariffs, its trading partners may respond with tariffs of their own, leading to a trade war that can escalate quickly. This tit-for-tat approach can damage international relations and create an environment of uncertainty and instability in the global market. The value of the US dollar plays a crucial role in the global economy. Its influence extends far beyond the borders of the United States, affecting international trade, investment, and even the economic stability of other nations. The dollar's strength or weakness can have profound implications for global financial markets and economies. As the world's reserve currency, the dollar is used extensively in international transactions, from trade to investment. This means that many countries hold large reserves of US dollars to facilitate global trade and stabilize their own currencies. The dollar's dominance in international finance is a double-edged sword, providing both stability and challenges. When the dollar strengthens, it becomes more expensive for foreigners to purchase US goods and services. This can lead to a decrease in demand for American products abroad, as foreign consumers and businesses find it more costly to import from the United States. Consequently, US exporters may struggle to compete in the global market. This can lead to a decline in US exports, potentially impacting economic growth. When exports decrease, American manufacturers and producers may face reduced orders, leading to slower production rates and even layoffs. The ripple effects can be felt throughout the economy, affecting jobs, wages, and overall economic activity. In the context of Trump's tariffs, the dollar's surge can be attributed to several factors. Tariffs are essentially taxes on imported goods, and when they are imposed, they can disrupt international trade flows. The uncertainty and tension created by trade disputes can have significant effects on currency values. Firstly, tariffs tend to reduce demand for foreign goods, leading to a decrease in the supply of foreign currencies in exchange for dollars. When fewer foreign goods are imported, there is less need for foreign currencies, which can cause their value to drop relative to the dollar. This dynamic can contribute to the dollar's appreciation. This relative scarcity of foreign currencies pushes up the value of the dollar. As the dollar becomes stronger, it can create a feedback loop where the demand for dollars continues to rise, further strengthening its position in the global market. This can have both positive and negative consequences for different sectors of the economy. Secondly, the uncertainty generated by trade tensions often prompts investors to seek refuge in safe haven assets, such as US Treasury bonds. These bonds are considered low-risk investments, and during times of economic uncertainty, investors flock to them for security. This increased demand for US Treasury bonds can drive up the value of the dollar. This increased demand for dollar-denominated assets further strengthens the dollar. As investors pour money into US assets, the influx of capital can boost the dollar's value even more. This phenomenon can create a cycle where the dollar's strength attracts more investment, perpetuating its dominance in global finance. While a strong dollar can benefit American consumers by making imported goods cheaper, it can also harm US businesses that rely on exports. Cheaper imports mean that consumers can enjoy lower prices on a wide range of products, from electronics to clothing. However, for businesses that depend on selling their goods overseas, a strong dollar can be a significant disadvantage. A stronger dollar makes US goods more expensive for foreign buyers, potentially leading to job losses and reduced profits. When American products become less competitive in the global market, businesses may see a decline in sales, which can result in lower revenues and profitability. This, in turn, can lead to cost-cutting measures, including layoffs, affecting workers and their families. The stock market, often seen as a barometer of the economy's health, reacts swiftly to news and events that could impact corporate profits and economic growth. In the case of Trump's tariffs, the stock market's response has been decidedly negative, with major indices experiencing significant declines. The imposition of tariffs introduces a high degree of uncertainty into the business environment. Companies with global supply chains face the prospect of disrupted operations and increased costs due to tariffs on imported components. This uncertainty makes it difficult for businesses to plan for the future, leading to reduced investment and hiring. Furthermore, the threat of retaliation from trading partners creates additional risks for U.S. companies operating in foreign markets. If other countries respond to U.S. tariffs with their own protectionist measures, it could lead to a decline in global trade, harming businesses that rely on international markets.